Ladies and gentlemen, welcome back to the Peterson Institute for International Economics. I'm Adam Posen, president of the Institute, and it's my pleasure, privilege, you name it, to present a speech today by Dr. Peter Praet, member of the Executive Board of the European Central Bank, talking about current issues in monetary policy. This is obviously a critical juncture for the euro area. Some people will get sick of us repeatedly saying that. But I think no one is sicker of that than the people in Europe who are suffering from unemployment, from slow growth, from poor business prospects, from now rapidly declining inflation, actual and forecast, as well as declining wages. So the idea that we should be sick of talking about the euro area strikes me as odd. It remains critical. There was a reason why the G20 at the fall annual meetings of the fund and the bank were focused so much on European issues, and we are delighted that Peter is with us today to tell us from the front lines about what the ECB can and should be doing at this point. Before I formally introduce Peter and allow him to take the stage, which of course is what you're mostly here for, it's my pleasure as well to announce the publication of a new ebook by the Institute today, Rebuilding Europe's Common Future. It's available on the website. The people here together have hard copies. Our message is about combining growth and reform in the euro area. This set of proposals, I'll dare to call it an action plan for Europe, is worked together with Angel Ubide to put together a group of our leading scholars who focus on Europe, including A.J. Chopra, Jacob Kierkegaard, Paulo Moro, Nicolas Veron, as well as Angel Ubide himself. And we, as I think arguably the best place outside of Europe, with Europeans following Europe, have an advantage that we do not suffer the constraints that my colleague Peter, as a sitting central banker, does, or for that matter, our friends like Hendrik Enderlein and Jean Pisani-Ferry do, as people responding to requests from the French and German governments. We can look at the Gesamt concept, at what altogether has to happen. Now, what we have done in this briefing, which is part of our new series of PIAE briefings talking about multiple perspectives on a current issue, is stress that until now there's not only been a false narrative in economic terms driving a lot of economic policy in Western Europe, but that with the results of the last few months, the trend toward deflation, the lack of recovery, the failure to see credibility emerge in anything but the sovereign debt markets where the ECB has been directly guaranteeing, the policy has no longer any close, that it has truly failed. And it has failed in the most fundamental sense in that some would have argued this was the path that would lead to the most reform, both on the fiscal side, on the structural side, and that would in turn lead to the credibility and the confidence. And what we have seen is far too little structural reform on any metric in return for the amount of pain inflicted, and far too little return of confidence, understandably, because there's been so little progress on reform. And one can similarly talk about a negative feedback loop in fiscal areas where, with a couple exceptions, the slowdown in growth and the decline in inflation has outstripped the efforts made to consolidate budgets. So things have to change. And our assembled authors, they each have their own share of the proposal, each responsible for their own, but we essentially say that there are three critical components to Europe moving forward. The first is that it is time to combine positive macroeconomic stimulus as a normal policymaker would in these circumstances with reform, instead of seeing these as in contrast or in opposition. Stimulus should be complementary to reform. Second, that reform has to, both fiscal and structural, has to be more substantively targeted towards productivity enhancement and not as focused solely on wage compression or what's called internal devaluation. Our colleague Jacob Kierkegaard has an essay talking about the right ways to get labor market structural reform that are not solely about crushing wages, but more about deregulation and liberalization. Our colleague Paolo Moro talks about how the fiscal compact can be properly applied and other measures like spending reviews can be put in so that it's not just about deficit targets that get missed, it's about properly and sustainably getting fiscal policy improved. And we have Nicolas Veron talking about the need to build on the success, the one area where we've had clear success in Europe in banking supervision, by moving rapidly towards capital market union as a way of breaking down barriers in the services sector and revitalizing business in Europe. All of these take place in a context that, as Jay Chopra argues in our essay, and Angel and I pick up in the introduction, which has to be a complementary approach of reform and growth, but also a recognition that there's been too much voice given to the northern countries' interests in contradiction of both political legitimacy and economic efficiency. This has to be about Europe coming together and serving all of Europe and not just the interests of the creditors narrowly defined. Finally, in this group, Angel Obide has an essay calling for a more advanced, symmetric, forward-looking inflation target for the ECB, that their mandate should not be well below 2%, as has been interpreted in the German press lately as satisfactory as long as we're above zero, which I think most of us would agree is not. And that the QE, when it comes, that the aggressive stimulus policies should be determined by the amount it takes to get to the target and not by a preset notion of what the size of the balance sheet shift should be. This is something I myself advocated in various forms over the last few years, both at the Bank of England and since joining the Institute, and I'm glad to echo Angel on that. We encourage you all to read this, to comment on this, and to, as much as possible, thrust it into the hands of public officials and politicians in Europe to rethink and realize that this is a critical moment. The end of the acute crisis does not mean that the end of risk to the European project has come. If anything, recent developments say the risk is real and that it demonstrates the failure of the approach taken to date. Of course, what really matters are the senior policymakers and what their choices are, particularly in the monetary area. For that, we are indeed grateful to have Dr. Peter Praet with us, the chief economist of the European Central Bank. Peter Praet has been a member of the European Board of the Executive Board, of the European Central Bank since 2011. He was previously executive director of the National Bank of Belgium between 2000 and 2011. Very involved in various trans-European international committees. He had been chef de cabinet of the Belgian Minister of Finance from 1999 to 2000, has experience in Fortis Bank in the private sector and from 88 to 99. Of course, spent a little time here at the fund in his early days, was very involved with our colleagues at Bruegel in setting up the think tank that is the European descendant of ours. And we're just grateful to have Peter back. Peter, please.
Thank you. Thank you, Adam. The last time I spoke here was, I think it was May 13. I don't know if you were there. And I was looking backwards at my notes at that time. We had inflation 1.4. Now it's 0.3. It's 0.3, the latest. We had also interest rates, to just give you a few examples, in Italy or Spain, slightly above 4% for a 10-year bond. Now it's below 2%, or it's 2% today in Italy, slightly below 2% in Spain. So there have been a lot of changes in financial prices when we look backwards where we were at that stage. The euro was 130, now it's 120 and something compared to the dollar. But the message which was given at that time on the economy was that we were envisaging a modest, fragile, uneven recovery, subdued price pressure extending into the medium term, and also a very weak money and credit dynamics. And I was here expressing worries about the pace of deleveraging in Europe in general. That was basically the context. So we had decided about the number of measures in the period since then, cuts of rates. Now, as you know, we have a negative deposit facility, and we came between June and October with new measures which we call the credit easing, which implies also the purchase, outright purchase of assets, as you know, covered bonds and ABSs, senior tranches of ABSs. Now, we are in the situation, and you have seen perhaps the results of the last Governing Council meeting. We basically said that we remain very vigilant, and I will explain a little bit the context now. But basically, we were highlighting two contingencies. First is that the measures that we have decided between June and October will not bring the desired effects, the degree of monetary accommodation that we think is necessary in the present context. So that's the first one. So we'll talk about this issue. The second is that we would have a downward revision of both growth and inflation, and which we had actually because we had the latest projections of the staff were published last week, actually. And you have seen a significant downwards revision in growth, but also in inflation. Now we have this oil price shock, which is more recently more supply-driven than demand-driven. In the beginning was largely demand and supply. Now there is a supply side, you know, in the supply of oil. And basically what we said is in January, so very early next year, so we mean January, we are going to make the assessment of the situation also on the oil price. The basic question there is to see the question which is discussed also in the United States, should we look through? You know about the effects of the oil prices, the second round effect, as you know, there are direct effect, indirect effect, and then the second round effects. Usually central banks look through. The question which we have to ask ourselves is, given the fact that inflation expectations are fragile and the risk of de-anchoring of inflation expectations exist, we cannot deny it, the question is to what extent should we look through about the impact of oil prices on the headline inflation rates, Because as you know, the projections were done with assumptions of November about the oil prices, and if you would update the inflation projections in the short run in 2000 and end of this year, and December and January, February, you may get negative figures for the headline inflation. And then the question is for the central bank, you have to look through by saying that probably oil prices will go up later on, that second round effect, we have to wait to see the impact of second round effects or not. That will be a key discussion in the January 22nd meeting. So the monetary policy meeting in January, I draw your attention to that, is the 22nd of January. We will have a meeting before when we will update in a more informal way the assessment of the economic situation. But the monetary policy meeting will be the 22nd of January. So there's a little bit time to make our homework on this. We also very clearly indicated that we want to be ready to take, if needed, additional measures if the assessment I just mentioned with the two contingencies will require to take additional measures. So we have tasked our different committees, the Monetary Policy Committee, also the MOC, the Market Committee, but also we asked the lawyers and we asked the risk managers of the bank to work on the additional non-conventional measures if needed. And that would include the purchase of a broad range of assets, including perhaps sovereign bonds if needed. So that we are working on, without any taboo, about any program of purchase of assets. So any taboo, but we want to look into the details because, as you know, in your era, there are a number of institutional constraints. Let me go and looking at some of the slides I prepared. There will be written comments that go more into the details of the policy measures that we have taken. I wanted to go through a little bit the picture via a number of graphs. First is on the left side, you have GDP and the economic sentiment indicator of the European Commission and the PMI, the green line. You have seen, and we have detected that relatively early, that the economy was losing momentum. We said that already in the end of the spring of this year, that the economy was losing momentum at an early stage of a weak and uneven and fragile recovery. which was a very strong signal, I thought, about the concerns of the central bank and the readiness to act at that time. You have seen that since then, the economy has broadly stabilized at a quarterly increase of GDP of 0.2, not annualized, 0.2 per quarter. And we have the impression of an economy which is settling in a sort of low growth regime, a sort of 1% regime, so we are not really fearing a sort of recession, although we say that with a very fragile growth, a recession could come if there are additional shocks. But I think the main worry that Adam was flagging when he was talking about structural reforms is that we tend to go in a regime of low growth, where when you talk to business and you talk about investment plans, basically the business will tell you that the capacity utilization in business is relatively normal, not so far away from normal. That's a micro view. On a macro view, of course, you know that there is an enormous degree of slack, and so you have the sort of underemployment sort of regime in which I think is the biggest risk we have today in Europe. When you look at the inflation story, we had experienced in 2008 an increase of oil prices and commodity prices, followed by a correction. But what you see with the red line, which tells you the core inflation, excluding food and energy, you have seen first that there's a relation between the core and the headline. I mean, obviously. When you look at that with simple econometrics, you will see that the core inflation reacts with relatively small lags, and it's more recent, to the headline inflation. So there is an impact of the headline on the core inflation via the direct impact, not so much today about the second round effect. But this is the big question. The indirect effect is, for example, on transportation costs. For example, in a weak growth environment, if you have a reduction of oil prices, it is possible that the transport sector will pass through directly the weaker oil prices in the selling prices, so that we call it the indirect effect because of competition in a weak demand environment. So we have to be very watchful about the impact of headline inflation on the core inflation, and this in a context of weak growth and a context where you have signs of fragility of inflation expectations, certainly from what you can read from the market prices. What you also see in this graph is that when you had this fall of oil prices and commodity prices in 2009, the inflation level was higher than what it is today. So we start from a lower base with a positive supply shock, of course, but from a lower base of headline inflation. So one of the main discussions that we are going to have in the beginning of next year is the question of looking through. You know the discussion in the United States on this. You have a discussion in Europe. But I tell you the context is quite different between Europe and the United States. We ask ourselves this question: to what extent can we be patient and wait to see the impact of oil prices and looking at the second round effects? So I don't give you the answer now, of course, because that will be the meeting of next year. But asking the question, I think, is already important. The second point here is also, I mentioned at that time in May 13 when I was here, the weak monetary and credit dynamic that you have. You can see the blue line M3. You know, this part of what we call our second pillar in our monetary policy strategy. I think what is very interesting to see is that in the course of 2013, we had a weakening of M3, a significant weakening of M3. And you see, again, the same sort of characteristics where the banks actually were in a deleveraging process. You see that from the credit side, but where the banks were actually settling for a sort of weak economic environment. The banks were reducing their balance sheet at that time. They were starting to reimbursing liquidity which was provided by the central bank. And if you remember, in June 13, there was a discussion about how the central bank should interpret the weakening of M3. There was a good news and a bad news. The good news was that the banks were reimbursing the central banks, which means that from a liquidity point of view, the banks were more solid because they were, able to reimburse the liquidity provided by the central bank. But from a macro point of view, the bad news is the banks were able to do that by cutting on their credits and reducing their balance sheet, which was macro bad news at that time. The central bank continued to react, and basically, increasingly, the focus of the central bank was on credit easing instruments, and that's what I will explain a little bit later. Now, as Adam was saying very rightly, and that was a message that we decided to give, and communicating a sense of urgency, which you do now, Adam, is that you have this triangle of monetary policy, fiscal policy, and structural reforms. They have to work together. I think it's very important also to say, and I would say, me as a central banker, that I look at monetary policy per se. I have a mandate, it's price stability in the medium term, as has been defined, inflation close to 2% in the medium term. Monetary policy has to act if you think that the main purpose of the reason why this institution has been created and granted a very strong independence, if you think that the mandate is at risk, you have to act. Also independently of what the other authorities do. At the same time, you have to communicate to the other authorities that monetary policy cannot solve the problems per se. It would be a catastrophe if all the burden of adjustment would be for the central bank. Obviously, it would not work in the end. But it's not an excuse for the central bank not to act if it feels that its mandate is not fulfilled. And that's the discussion. I want to see it very clearly. So there's no question of coordination. It's a question that each authority has to take its responsibility, knowing that if the others do not act, it will end up in a very bad state. So you have monetary policy, fiscal policy, and structural reforms. I will not go in all this. I would also say, Adam, that in structural reforms we should not, it's probably too slow. A lot has been done, by the way, also. We see also, for example, I'll just give you examples not to discuss now, but we see, for example, signs of steepening of the Phillips curve. We see, for example, the relation between a change in GDP and change in employment is much stronger, so employment reacts much faster to positive changes now in GDP than it used to be in countries like Spain, for example, countries like Portugal, also Greece, for example. So you see a number of things, but it's too timid, obviously. You see it also in the banking sector. We have done a lot. But again, we get this impression that you have done a lot, but it's much, much more to do in the coming years, unfortunately. And then comes immediately the political questions about the ability of governments to push through these necessary reforms, because that's one of the main themes for 2015, is the politics of reforms, of course. So I will not go into all this. Fiscal policy has been quite difficult, because we have this fiscal stance is broadly for 2015 neutral on average. But as you know, there is fiscal space in a country that doesn't really need it. And there is no space in countries that really would need to have some demand support. And saying that the country that has fiscal space should spend much more would work if there would be huge spillovers from one country to the other country. A simulation indicated that the spillovers exist, but they're not very, very high also. So that's a discussion I don't want to have here, but this is also a discussion we have at the European level, because if you say that some countries have to reduce their fiscal deficits, but at the same time, if all countries having fiscal space don't move, then the fiscal space, the fiscal stance would become restrictive on average. And do we want this at the European? So these are the discussions we have at European level now, so I don't go into that. As I say, I'm a more monetary policy maker. So monetary policy there. At the same time, we have to address the design flaws of the single currency, and in particular, the banking union. I will talk a little bit about the banking union from the monetary policy point of view. Just to give you a hint now, is that when we came with a comprehensive assessment, we had in mind that maybe the exercise would have some pro-cyclical impact, because the banks would be very careful and try to build capital and perhaps restrict credit in the period before the finalization of the comprehensive assessment, fine. But after the finalization, the banks would then be in a better shape and would be more ready to lend, basically. Now, what we see from the figures of market prices of banks, we don't see that really now. We see the price-to-books ratio of the banks remain rather weak now, and this confidence impact is not yet there. And so there is a lot of work still to do on the banking side in Europe. I think we have done a lot, but the implementation of the single supervisory mechanism is the question for 2015 now. So that also unfinished work, I would say, here. In monetary policy, very quickly, the initial conditions, never forget, is bank intermediated or capital markets, except for sovereign debt or capital markets, are not very deep, not much volume around. So that's one constraint we have. Very highly heterogeneous environment, we know that. Also rather low inflation at the beginning of the financial crisis, also meaning that we very quickly hit the zero lower bound. We did it in September officially, where we said we have reached the zero lower bound in September 14. We said it explicitly. No centralized budget, of course, at European level, but also constraints on national fiscal policy. For example, you have in the treaty, I think it's important to remember some of the articles of the treaty. 123 is no monetary finance of fiscal deficit. The 124, Article 124, is no privileged finance for the government. But 125 is an article, no bailout for the countries being in difficulties, no bailout from the other countries. So you have a number of institutional constraints on fiscal. There is no fiscal union, of course, but a number of institutional constraints related to sovereign debts in general, which complicates very much also the action of central bank, you imagine. Institutional vacuum in crisis management and crisis resolution, we know that. We worked a lot about the banking resolution scheme. I don't know if you have seen that, but the single resolution board will be in place for January, and the Parliament has finished the hearings of the candidates, the 6 candidates. And as you know, the President, you may have seen, the chairwoman of BaFin is the proposed candidate by the Commission to lead the single resolution board. So I think all these things are being put in place, but still the context remains extremely fragile, extremely difficult, and there is a lot to do, remaining to do. If you look at monetary policy, not so complicated actually. You have the standard measures, but as I say, in September 14, we reached really the zero lower bound. The non-standard measures, we are in this bank intermediated environment. So basically what we do is repos. We lend to the banks and we can influence the price, of course, interest rates, the collateral, the eligibility of collateral, but also the term. We can lend for, as you know, we lend for 3 years. Now we are lending for 4 years, and it's linked to credit, to the loan book, to the expansion of the loan books of the banks. I don't go into the details here, but it's basically a repo-driven monetary policy that we have, which means essentially, and this is a key question, essentially it depends on the demands of the banks. If the banks settle in a sort of low growth environment, from the micro point of view, they may not demand credits, of course, from the banks, because they say in that environment, why should I make credit? Because my customers anyway will settle for an expected growth path of something like 1% of GDP, not the 2% that we used to have. And so you settle into a low growth environment, so your monetary policy will not reach it because it's demand driven, and the demand is sort of settled into a sort of underemployment equilibrium, as we know in sort of Keynesian sort of environment of underemployment equilibrium. So that's the reason why the central banks then, being in an environment, a bank intermediated environment, we thought that the comprehensive assessment would be a key milestone to do. Now we have done that, but unfortunately it's not yet finished. The banks still have a number of challenges to do, so this is not yet unblocked, I would say. The second thing is that you can improve the conditions. You make longer term lending to the banks. So you take duration risk on your balance sheet. And you even accept that the banks replace bonds that they would have issued to get term funding by central bank funding. So there would be a sort of impact of portfolio rebalancing as we have in QE, because if the bank doesn't renew a bond which comes to maturity, because it goes to the central bank, the holder of a bond will get cash in place of renewing a bond, and will use the cash to buy something else, another security. So all these things, we know that, and when we came with the TLTRO we knew that that would be one impact, not related to lending, but would be a sort of portfolio rebalancing effect. The problem that we see today is that the volumes are probably lower, and I expect it to be lower than what we expected when we launched the program between June and October, probably because of what I said before, a sort of underemployment, sort of equilibrium, sort of psychology that you start to have in Europe, which is very difficult to change, of course. This is the biggest risk, as I said in the beginning. So once you do your repo, because it's demands, you put incentives for the banks to get the liquidity. If the banks still have settled for a low equilibrium, sort of low growth environment, the only option that remains, because rates are already at the zero level, the only option that you have is the balance sheet, expansion of the balance sheet. And that's what we have said. We have said that the measures that we have announced, this repo included, will have a sizable impact on the balance sheet, Mario Draghi, in his communication, referred to the figure of 12, March 12, which the difference with the balance sheet today was about 1 trillion. This was not an objective. Okay, that's very clear. We don't have a balance sheet objective, but at the same time, we calculated the degree of monetary accommodation which is necessary to address the situation I described. And the figures we get to have an impact on inflation in the medium term amounts to the figure that refers to the balance sheet of 12. So it's not to say, we want to go back to the balance sheet of 12. But we calculated that to have an impact, the degree of monetary accommodation that is needed gives you a figure which brings you back to the balance sheet of 12 in that region. It's very difficult to say precisely what it is. The reason is that it will depend, it's the impact on inflation and on the economy, but inflation in this case will depend also of the measures that you take. It's the balance sheet. You can increase your balance sheet by buying treasury bills, for example. That will not have a very big impact on inflation in the medium term. Or you can, on your balance sheet, you can buy, of course, assets which are impaired on the markets. And then, of course, the impact for €1 spent on your balance sheet will be much bigger, of course. So when we say we want to take measures which have a sizable impact on the balance sheet, we talk about size, but also on composition. And the reason on the composition, of course, the more you buy impaired asset, the higher the impact and the lesser the volume you have to buy. And vice versa. If you would buy AAA bonds, for example, for each unit that you spend, the impact on the economy will be weaker, of course, and the volume may be bigger. So one of the reasons of our communication on the balance sheet, we talk about the size, the composition. We give an ordre de grandeur, a size which will bring you back to the balance sheet of 2012. But it will depend on the concrete decisions that we will take, if needed, as I say, depending on the assessment of the situation, which has been weaker, as I said. So this is already one piece of information we have and we'll reassess in January. And the other is the impact of the measures we have already decided. As you know, we will have a TLTRO. Second auction will be tomorrow, Wednesday. We know more or less the figure. So we'll reassess a little bit about what is missing actually to reach the degree of accommodation that we think is necessary. We can also use forward guidance. We did it very successfully when I was here. We'll show you the graph. But when I was here in May 13, in July, we came with our forward guidance. It was the environment of tapering, US tapering. And we could, if you look, you will see it now, the forward curves, the interest rate forward curves, US and Europe, you will see a very strong decoupling of the curves since 1.5 years now. And then I mentioned the credit easing package. We complemented the TLTRO, which, as I said before, depends on the demand of the bank. But since we wanted to regain control on the balance sheet and not only be depending of the demand of the banks, which I explained the context, a sort of underemployment equilibrium sort of context, we wanted also to inject liquidity by outright purchases, and we targeted our liquidity to the markets which we think are the most impaired. Now, it's very difficult to do. We address the ABS purchases. We are still, we started last week, and we have an amount which is around 600 million of purchase, which is very small. But we want to develop that market because it will make for the banks, the deleveraging of banks, that's our hope, more easy if we have more developed capital markets in Europe. So that may take some time, but it's something we have to do, and we will continue to do that. And the other is the covered bond purchase program, which is also linked to credit conditions, and we are in the 20 billions of purchases now. Now, I explain here the measures. There has been, I think it's very important to go very quickly into that. The transmission we know, the portfolio rebalancing mentioned there. It underpins also the forward guidance and the determination of the Governing Council to secure expansionary stance over an extended period of time. The measures will have a sizable impact on the balance sheet, which is expected to move towards the dimension it used to have at the beginning of 12. Last week we hardened a little bit this language. It's not only expected, now we say it's the intention to have it. It is a signal. It's not a very, very strong signal because what is an expectation? It wasn't an intention. And we could have added a firm intention also. We could have played with the word. I wouldn't make too much of this. But I think what is very important is that we have an assessment that the degree of monetary policy accommodation will require a substantial increase of the balance sheet. And we have a reference to what we think is necessary, and the size I've mentioned before, and we will do what is necessary to reach it, because we think it's necessary, to fulfill our mandate. So there is a commitment to further use non-standard measures if needed to address price stability risk. I show you very quickly the forward curves. The red is the US and the blue is Europe. The dotted lines is what it was in April 2013. You see December 14, how the two curves have diverged. This is part of policy. So we want to also to ensure that our forward curves remains, very different from what it is in the United States. And a discussion today is to see if additional monetary accommodation is needed, which will be reassessed in January. You may think about flattening further the OIS curve or the forward curve, flattening it further. So this is, if you take additional instruments, you could do that. Could do that in different ways. You can do that by purchases of assets. It's something you can do. Another is the other measures that we have taken. I think it's important to go what we did. Here, the bank CDSs and the sovereign CDSs. And Nicolas, you're there, but it's something which is not yet solved. We have the sovereign CDS in banks. I take the case of Spain. So all the little balls there are banks, individual banks. I don't give the names. And you see how it moves between 2010 Q1 and 2011 Q4. You see the cluster of banks move together with the state. This strong relation between CDSs, state and CDS sovereigns. The VLTRO we did at that time brought it, back. You see the points there. The pre-OMT, all the cluster goes the wrong direction. Post-OMT, we go left. So this more or less now. And then you see the latest, how it goes back to the left. But still you see that the relation between CDS sovereigns and CDS banks, even in a country like Spain, is still very strong. So there's still a lot of work to do to decouple that. I don't have time to discuss that, but still something we have to keep in mind. And we have to be very watchful for this, because in case, of course, a bad scenario would unfold, we still have this link between sovereigns and the banks, which still exists in spite of the measures we take, in spite of the no bailout, the bail-in measures, regulation, directive that we have now. This is something we still have to be watchful when we think about shocks, in the economy, or if we would move to a bad equilibrium. It's very important to notice, because the central banks, to be alert, we have some experience with this bad loop. We try to address it, but it's still there. That's the dispersion of long-term rates. So as I mentioned before, a lot of accommodation de facto has happened via the compression, the huge compression of spreads. Now, when you look at these figures, you have to be careful, because when you look at real rates, real expected rates, and we do that exercise in the Governing Council, the real expected rates, what you see, certainly in bank lending rates, is that the real rates had not really fallen very much, because inflation have fallen faster than the capacity, the willingness or the capacity of the banks to reduce their lending rates. That's why we are still very much looking at credit conditions, and we talk still about credit easing, because in spite of the fact that nominal rates, lending rates went down, which is positive, since inflation went down, so we calculate expected real lending rates by using market prices for inflation, expected inflation for market prices, and you see that the real rates have not fallen very much, because inflation has fallen and inflation expectations have fallen very much. So we think there is still an important case to have monetary policy accommodations on the lending rates. That's the forward curves. So the green line is the latest, the forward curves is here. And you see that the Aeonia at 50%, you see you go well into 2019, I think now we are going back to 0.50. So it's still, when we look at this curve, it looks very accommodative, which it is. But when you take about additional measures if necessary, we cannot hide ourselves. It means that we want to push this curve. We would want to push this curve even further down, So we have already a lot, but the situation, we say, requires, this high degree of accommodation. But it may imply that this OIS curve should even go further down. Now, another point which I mentioned before is the price to books of the banks. You've seen that the price to books have recovered a little bit with the comprehensive assessment, but not very much, and so the situation there is unfinished work. And here you have the transmission of MRO rate reductions to the nominal, this time the nominal banking lending rates. On the left, you have the stressed countries. And you see the horizontal blue lines. These are the policy rates, which we cut to close to zero now for the MRO. And you see the red line, which is the lending rates of the banks. You see that the transmission of the cuts of the official rates to the lending rates, the pass-through has been relatively sluggish compared to what you see in the non-stressed countries on the right side. That's why we say our measures have still to continue to address the credit impairment. And here I go to the market-derived inflation expectations, which are drifting down. One has to be careful about the interpretation of that, of course, because as you see, the risk premium is not constant. And it may be that part of the drift down of inflation is that there is lesser uncertainty about inflation later on. So in the pricing of product, you don't only have the expected inflation, but you also the variance, or all the other moments of the statistical distribution around the variance. And these other moments may be smaller. But nevertheless, I mean, we think there are signs of, certainly signals of concern about inflation expectations, certainly. I think we cannot deny that. And last, for monetary policy, you have seen M3, and you have seen the base money on the right. And you see what I explained before, that the balance sheet expanded very much with the LTRO when we lent 3 years. We went into 3 years repos. And then the banks started to reimburse, but you see that money supply started to slow down, which means that the banks were happy to reimburse, but because they were adjusting to a weak, sort of economic environment. And that's what we try to correct now. That's why we came more forcefully with the message that we want to regain more control on our balance sheet, or regain control on the balance sheet, and that's why you have to go via outright purchases and not just depending on the willingness of the banks to go to you, because the micro and the macro do not fit together. I'm almost finished with that. At the last Governing Council, drawing that picture on the basis of the information of the staff, I was asking myself, let me put it, and that's in my written notes. I was asking myself if we would have interest rate margin at that time last week. I'm convinced personally that the Governing Council would have decided to cut off rates on the basis of the information we had. Now, why didn't we decide to take measure and say, let's wait a little bit more and see early next year what is the situation and reassess the situation? It's because when you go into unconventional policy, I'm talking outright purchases, there is not much asset you can buy if you want to have a volume effect, which we say it must be, if you want to reach, it's sovereign bonds. And with sovereign bonds, of course, there are constraints. There is not a fiscal union. If we buy sovereign bonds, which is part of the monetary policy toolbox, it's part of it, but you have also to see what are the implications and what are constraints of the treaty. You can buy AAA, you can buy a capital key, based on the capital key. There are different ways. You can buy corporate bonds, so there are a number of assets you can buy. And the exercise we are doing now with the staff is to see if we have to decide new measures to expand the balance sheet, what is the best combination you can have, also given the constraints you have in the treaty. So I don't want to be more explicit on this, but this is the exercise we do now. Just finished very quickly. I'm finished now, but on fiscal, you see on the horizontal you have the flow, the budget balance. In 2007, we had almost fiscal equilibrium. It was almost zero, -1. And we had a ratio of 65% debt GDP ratio. Then we had a big expansion in the crisis, 2008, 2009. The deficit went up, the debt went up, of course. And then we had a fiscal construction between 2010 and 2011. That continued to increase, also because of interventions in the banking sector. And then you see where we are now with almost 100% of debt GDP and with a deficit, a yearly deficit, which this year is at about 3%. So you see the situation of public finance. We cannot just say that you need fiscal expansion, because, of course, this is the average for the Union. We know Germany, for example, is much better positioned than Italy, for example. But that remains a serious concern. So we have to be careful about fiscal and the fiscal stance discussions. We want the fiscal policy to be more expansionary by looking at the composition of the fiscal stance as it is. But it's easily said. It's very difficult to do from the political point of view. For example, we say more investment in infrastructure. It's easy to say, or lesser distortionary taxes and lesser unproductive spending. It's easy to say. It's very difficult to realize, especially in the limited period of time. So that remains a big constraint. And you see, public finances are very fragile. And if you go into a program of purchase of sovereign bonds, you cannot just say, I buy, without having in mind the incentives, and a little bit the constraints of the treaty. So that's the exercise we do. But I repeat again, if we believe for monetary policy purposes, because of a mandate, we need to expand our balance sheet, we will do what is necessary to achieve that, because we think that's our mandate. And if that's the only way, we will do that. But the assessment is being done now. And then and I conclude from the beginning of ADAM is to say, these graphs, it's the GDP. The dotted line, it was GDP, the path that was expected at the beginning of the crisis, and now you have the level of GDP now. And this is the biggest risk that you have, and I will illustrate that with this graph, estimates of the output gap, whatever it is, a range of uncertainty. But the graph on the right shows you the dotted red line, the capacity utilization in manufacturing. The dotted line, it's very close to the historical average. So in terms of perception, when you ask businessmen, are you working at normal capacity, or you have too much capacity compared to the demand? They will say, we're about right, almost right. A little bit too much capacity, but not much. And so that's from the micro point of view, we start to get the impression that the firms say, well, I have adjusted my investment plans to a low growth environment for the coming years, not only for this year, but for the coming years. We see that in the service of business, there is very little expansionary, of course, investment. It's basically replacement of this is the biggest risk. And I go back to ADAM because we have a huge amount of slack, but at the same time, you have the impression that the firm's business is starting to change their mindset, their animal spirits, in sort of underemployment, equilibrium, which is from the political point of view, as you know, unsustainable in Europe, of course, because the macro slack is huge, And you cannot adjust to this low growth, low inflation environment. So that's why we say all the authorities have to take risk, have to take their responsibility, but they will have to take risk in the coming period. They cannot just say business as usual. They will have to take risk. Oh, yeah.
Peter, obviously, I'm very heartened by your comments at the end, as I think many people in Europe and around the world should be, but obviously it's the analysis you took to get there and the depth that you and your colleagues at the ECB in terms of grappling with this problem in practical terms and understanding the situation that the euro area is in that gives us the most hope for the future. We are getting you a little more hot tea. You've been struggling to present, and we're grateful. Before I open it up to the floor, let me, if I could, just ask you a couple follow-up questions on your excellent presentation. One of the things which you pretty explicitly said was, it's possible to separate the question of what kind of policy is needed right now. Are we meeting the mandate? What in terms of orientation? Do we need action? Do we not need action? And then separately, the question of what means do we have available to achieve such and such a goal? And I think that that's valid and the way that most central banks, frankly, do things. So let me just underline this. In terms of meeting the mandate that the ECB has by international treaty, with this kind of forecast, is there any argument that on the merits of the forecast and the mandate, the ECB should not be taking further action? Leave aside, there are other issues. There are issues of what you can do. There are debates over cost and benefit. But is there really debate left on the need for action?
No, you're right. You know that in 2003, it was Ising actually who communicated on this, the chief economist at that time, that in the treaty, it's okay?
Yeah.
In the treaty written, the mandate is price stability.
Right.
And price stability is zero. Now, the policy goal was defined as close to 2% for different reasons. One of the reasons at that time which was given was that to facilitate in the monetary union relative price adjustment across countries, what we call now the internal devaluation. Because if you follow 0%, some countries having to adjust relative prices would have to have negative inflation, this deflation. So that was the reason. It's only one of the reasons. The others, hedonic, things and the price correction, the quality, components, right, and all that. But it was clearly said at that time close to 2%, and it was always considered as the mandate. No, it is true now that you sometimes hear saying that as long as we are in the definition of price stability, some people say that as long as you're in the definition of price stability, you can be patient and right, just observe how the events will unfold. And that's an important discussion. I would say in the Governing Council, the mandate, my interpretation of the behavior of the group is that it's close to 2% is the mandate. What is the medium term is then the second question. And the medium term, we say, depends a little bit on the nature of shocks that you have. Some would say, mainly academics would say, we have to define it in more precise terms. Let's say it's 2 years or 3 years horizon. And we say it depends on the nature of the shock. But what is absolutely clear is that the question you have to ask yourself is, when you have a shock, can you afford to be patient to look for the second round effect, which we traditionally do? So when oil prices go up, we can say headline inflation goes up. We don't tighten policy necessarily. We want to see to what extent are inflation expectations impacted by that. And so we look at wage behavior and things like this, and we can be patient. The same questions come the other side now.
And can we have the luxury, do we say, of waiting in a context, the context which I described? This is a question which is not settled, and we put it in as a question mark in the last introductory statement, and there are different views on this. My view, as I expressed here, is, I don't give you the answer yet, but by asking the question and insisting on this, I would say that we have to be very careful not making a mistake, because it is likely that we get negative figures of headline inflation in a context where we see signs of fragile inflation expectations. I would not say that they are de-anchored, but I say the risk of de-anchored has increased and still increasing. And so we have to be very careful when we reason in terms of patient and let's wait and see for the second round effect. Because if you made the wrong calculation or the wrong choice, and you would have a de-anchor exposed, it will be very difficult to get out. So that's one point. There is a second point in the Governing Council, I think, has to do, as I say, I think there is a large consensus, even more than consensus, to say that if we had interest rate margin, we would have cut. But now that you enter into a difficult territory, which is outright purchases, there's not much to buy except sovereigns. Right. In the context I described, there is among some members hesitation on this, which is quite normal, and we have the discussion on this, on that. And so you would say that because of when you go from interest rate to outright purchases, there is a non-linearity in the reason. So you, for some members, I would say they're more hesitant. There is a third point which I would not very much put in. I think that one is more important than the other one, is that nobody knows exactly the impact of unconventional.
Oh, come on.
On the
you know better than that.
But that's why I put it at the end. Yeah. So, and I don't say, and no, I mean, it's uncertain, of course, but some would say, well, we don't know exactly what it is. And so you have some hesitation. I mean, but I think the second.
No, the second point is it. But I think it's very important, I think, and very reasonable for you to give us that nuance. Yes, drink tea, let her adjust the microphone. That's what happened. This is how you can tell he's really an economist and not a publicity hound.
I'm spoiled. That's the because they arrange it.
So, thank you, Jessica.
Thank you.
So, just to underline something you said, which I think was very important, that the question of looking through oil price shocks or temporary price movements, as the Fed has said they're going to do with the current oil prices in the U.S., is not about whether you're a headline targeter or a core targeter. It's about what you think the pass-through to the expectations would be.
Yeah, exactly. And in the context, the precise concept, I would not say that in another context, but in that context, I think we have to be particularly vigilant, as we say. That's what that will be one of the major points of early next year.
Now I want to just take you very briefly before we go open up the questions on the second half that, as you indicate, is the much more contentious part within the council, which is the issue of at what point is it worth it, cost versus benefits, to use these other means of asset purchases as opposed, if the overwhelming majority agrees we should be doing something, but we're hesitating for this reason. So obviously, as my colleagues Jacob Kierkegaard and Angel Bide and others in this building have wrestled with, and as you wrestle with every day, you have incomplete union. You have incomplete fiscal union. You have all these things going on. You talked about that a bit. At the same time, inherently, any monetary policy must involve some mutualization of risks. Otherwise, it's completely ineffective. I mean, just by definition, if there's going to be one interest rate that is affected, it must say that there's some set of securities or transactions for which the ECB treats everyone the same. So in practical terms, do you feel there are ways that you can limit the monetization or mutualization spillovers and still do QE under the current circumstances? I obviously think there's plenty, but it's much more important what you think. So
it's. I don't want, because we are reflecting on what you say. When I say we have to look at the balance sheet expansion, outright purchases, in a situation where if you want to buy, I mean, there's not much choice. I mean, it's government paper. And as you rightly say, monetary policy, by definition, a single monetary policy means that you have a shared balance sheet. So it's mutualization. And so there are ways to deal with that. And that's what we think. You can find ways to deal with it. But you have to make, I don't want, because we
Right, no, of course, it's in process.
But you have to make, you have to be very, very clear. You first must make as a central banker, your analysis about what degree of, do you need further monetary policy accommodation or not? I mentioned the two contingencies. One was weaker growth, which were signaled by the latest projections. And the other is that the measures we already took will probably, might not give the degree that you expected at that time. So it is still open discussion. Also, we have a positive supply shock, which may give a little bit more growth than what we expected a month ago when we made the projections, but not much.
Right.
But what we know is from the inflation, the pass-through of the most recent, since maybe that's something I can tell you. But when we made our projections, we came for 2015 with an inflation figure of 0.7. Now, if you would update that with the recent oil price evolutions, you would get a much lower figure for 15, because the pass-through of the recent is not small. So you will get something, I don't want to give a precise figure, but you would be much weaker than the 0.7, which is already very weak. And that's why we say it's quite important to think carefully about the risk of second round effect in the context where I say the mindset in general on the business side, but maybe also on the consumer side at some point will be to adjust to a low growth, low inflation environment, and then that's a de-anchoring process.
One last question. You mentioned, again, your talk was incredibly comprehensive, and I think we're all grateful for that. It helps us understand the mindset as well as the economy. One thing you didn't mention explicitly was the exchange rate. Which is always fine. I'm happy when somebody comes here and doesn't mention the exchange rate. But I just need to point out, you did have that lovely chart of, the U.S. interest rates going here and EONIA going here, and normally that would have some effect somewhere on the exchange rate. And so I mean, just in terms of your outlook, when you say, for example, the supply shock from oil prices is having the following effect, at what degree do you think current movements in the exchange rate are affecting your outlook?
Yes, it does on inflation. It compensates to some extent, but much lesser. So the oil price effect much bigger than what you have seen so far on the exchange rate. Also because you also have to look at the effective exchange rate, but that's a different discussion. Right. But on oil, it's theoretically a relatively good combination because you have a positive supply shock with a weaker currency for cyclical reasons. Right. I mean, it's not manipulated, as you know. It's just two diverging paths of monetary policy. It's two diverging paths of monetary policy given the condition. So a market price has to be able to adjust, which it does actually. But when you look at the impact on inflation, it's the dominating factor is not the exchange rate. So far, it's the oil prices and commodities.
Thank you. That's very clear. I'm going to open it up for questions. I always say we need to ask our guests outside the Institute to speak first. In particular, that's important today because Peter's going to have to leave right after the talk and isn't going to be able to take extra journalist questions. So, Jessica, if you could hand to the lady over there. We have, Jessica's holding a traveling mic up front. Yeah, I see people. I will get to you in turn. There's also a standing mic at back for those of you for whom it's easier to go there. Please identify yourself.
Thank you. Krista Hughes from Mr. Praet. I was interested, you were talking earlier about the January 22nd meeting and the assessment that you'll be taking there, how that will feed into your decision on whether to take any additional steps. Will there be a decision taken at that January 22nd meeting on additional steps? And also, because you said that you would have cut interest rates at the last meeting, if you could have, what magnitude of rate cut do you think would have been appropriate, and what would that equate to in terms of asset purchases?
No, it's very difficult to do a counterfactual exercise, but it is true that when you go into we did already unconventional, but when you go into unconventional, it's uncharted territory to some extent.
It's charted.
We look, no, but it's true. I mean, we use the experience. Actually, we do the experience of other countries. But it is clear in the mindset. If I would tell many people, for 1 trillion you get 30 basis points or 100 or even 100 basis points, maybe with big eyes. I mean, you have to. No, I cannot answer your question. I don't know what would be the size of interest rate. I just say that if you had margin, you would probably have used it. The fact that you go into unconventional in the context I described with no fiscal union and all that makes that, I can understand that it deserves a very careful reflection about, and that's a little bit the chemistry that you have in the council. I think on the assessment of the situation, that the situation is worrisome, and some may insist more on the structural reform and say monetary policy is already extremely accommodative, what more can you do, and things like this. It's the worries that you can also have about the first shooter. You do something in the monetary, and the other authorities say, thank you very much, I just don't do anything. So, but as I said personally, you have a very clear mandate, you have a toolbox, and if you think that the reasons why I signed my contract when I joined the institution, and you think that you are not, you have risk of not fulfilling your mandate, you have to use a toolbox that you have. Now, of course, there are other things you could do. You can reinforce the forward guidance. You can mix things. You can. I'm not saying you have to jump, in purchase of government bonds. We can also buy corporate bonds. So that's what we are really studying now. But it is clear that we start with credit easing because normally for €1 spent on your balance sheet, when you address impaired markets, you have much more impact than if you would buy markets which are not impaired or AAA assets, of course. And then the volume you would need to have the same impact would probably be much, much bigger, of course. And that was very well understood in the United States. In a way, when we look at the experience of the United States, with hindsight, it looks very simple. But at that time, when the Fed had to take the decision, I was, by the way, discussing that with colleagues of the Fed today. But when at that time they had to take that decision, it was extremely difficult to take the decisions. Now, there are other questions you say, because I don't know the answer, but you could say in January, don't forget January will also, in principle, that's where we hope we can come with minutes already. So that's also an important consideration, because we say early next year, we will come with the accounts also. So that's another consideration in the chemistry of the functioning of a committee. And another point you can also say, you can take a decision and the implementation comes a bit later, as we did with the ABS. I don't know, it depends. So these are things which are not that important now in terms of signaling. There is another point, for example, when you go for outright purchases, you have open-ended. That means that you say, I don't know exactly how much because it's composition, size, composition, and pace. Pace has to do with signaling. Right. Composition and size. So you don't know exactly because it depends where you want to go. So open-ended from that point of view would be superior. But then to stop an open-ended is not so easy as you have seen in the United States. You have to say, I will exit from this open-ended purchase program when inflation will have reached something, or you have to say something of that, which is not so easy to communicate. Or, as we have seen in the US with different QEs, you can say, I take an amount which is the best of my loan, it's what we need. That's, for the time being, a little bit what we referred to, the best as we need. But you cannot have a precise figure because it will depend also on the composition of the purchases, depending where you go. I think that's not too difficult to understand that. It's not because we hesitate, but it's technically it's complicated technically, but it's not a question of hesitation, I would say, there, for those who are in favor of more accommodation, of course.
That's great. Krishna?
Thanks, Peter. In fact, you touched just a little bit on this in your answer to the last question, but your speech, you discussed size and composition.
Could you identify yourself, please?
Forgive me, sorry. Krishna Guha, Evercore ISI, formerly New York Fed. In your speech, you discussed the size and composition of the balance sheet. In Draghi's most recent Frankfurt speech, he used the phrase size, composition, and pace.
And pace, yeah.
So
which we put in the introductory statement as well.
Indeed, yes. So I wanted just to invite you to elaborate a little bit on how you think about the question of pace. So we've talked about a size of the balance sheet, a delta of broadly $1 trillion, but this was initially in the context of a 2-year program for covered bonds and ABS. Ought we to assume that that's the appropriate time frame, or is there also a discussion as to whether we should get there in 1 year versus 2 years?
Well, you know this debate between those saying if you're perfectly credible, sort of guidance, perfectly credible, you don't have to buy in the end, because you will influence the curve. Now it depends. If you have frictions in the markets, it will not be equivalent, even with perfect credibility. When some pockets of the markets are impaired, so it's not equivalent. But but you can do a lot via credibility. Now, what we have now is that there are a lot of doubts in the markets on our, not necessarily on the willingness, although when we change the word in intention, we want to reinforce a little bit the communication in terms of willingness. Intention really is our intention to do. But there is in the market a more skepticism about the capacity even to realize the objective that you wanted to realize. That means a degree of monetary accommodation which is needed, blah, blah, blah. And markets say, well, with the banks being in that, I call it underemployment equilibrium, and the narrowness of capital markets, covered bonds and ABSs, it's unlikely that you succeed in doing that. No, so that means that either, I'll give you an example. It's pure an example. Be careful. I say that for the journalists.
You don't have to give the example.
By forward guidance, by forward guidance, you could say it's the future short-term rates if people believe you or not believe you. But suppose they believe you. Or you buy AAA bonds. Because the AAA bonds is really the OIS curve. And the OIS curve is really, if people believe it, is a future short-term rates. So buying cash reinforces very much the signal. Now buying other assets may be superior even, or may reinforce it further, if there are pockets of impairments in the markets like the loan markets, for example. So, and then you have a comprehensive tool set where you use communication, but also effective purchases on the market to reinforce the signal, because you are not perfectly credible because say you're not going to reach it. So by buying, you reinforce the signal, but also not forgetting the impairments questions. So addressing some of, more specifically, as we do with the ABS purchase program.
And that's what you and I talked about at the Sintra conference of the ECB a few months ago, ahead of the ABS purchase.
But you see, if you could buy, address the impaired part, it would be for €1 spent on your balance sheet, you have the biggest impact, of course. And then the volume is smaller, needed to realize, and vice versa. And I think that's important when people say, what is the precise figure? I think we estimated a sort of figure, which brings us back to the balance sheet of 12, more or less. Not talking about a couple of hundreds, but more or less. But it's sizable. And we wanted to give a sort of, to refer to some figure, just to show our intentions, that we are not talking about small amounts.
No, that's great. The gentleman at the back.
Thank you, Adam. I'm Gonzalo Garcia from the MS of Spain. Very quick, 2 questions. The first is on your example on the charts on the sovereigns and the banks' CDS spreads. Don't you think that the most striking thing about those charts is not that they're still linked, but the impact that the OMT had on those spreads? It's something that we're missing, because we've talked a lot about that. The second question
But that was what is the question there?
The question is, don't you think that it's more striking that the effectiveness of the OMT in driving those
that was good. That was good indeed. That was what we wanted.
Okay.
but
Try your second question.
Okay,
No,
I'll
but
try the
that's-
second. It's on slack. You mentioned several times that you think the slack in the euro area is huge, but then we saw the chart and it's about like 2.5% or something like that, which, if I'm not mistaken, is actually below the slack that is estimated for the US. What do you think about the need to revise the way we estimate the slack? If you think that.
No, that's a very important question. For the time being here, for example, the OECD has much more slack in countries like Italy, for example, which is quite high, and we see the differences. From the operational point of view, at this stage, unfortunately, I can say it doesn't matter very much, because the closing of the gap at best, even if you take the most optimistic, so the slack relatively, it's not small. These figures are not small, but even taking the more positive, figures, it takes you at best 2018 to close that gap if you make the projections. So in terms of policy horizon for monetary policy, it's sufficient to say that to close the gap, it's an extended period of time before you can close it. Of course, you can say it's even worse than what you think, but from the operational point of view, I think it's sufficient what we see. But it's a discussion. For the time being, it's much more a discussion in the fiscal to look at the structural balance. For example, Spain, a number of countries are arguing with the Commission by saying about the structural balance.
I'm very cognizant of Peter's time as well as his throat. So what I'm going to ask is that we collect 3 questions. Randy, Morris, and the lady back there, Tara. And then if we get through those, I'll get to that gentleman and that gentleman.
Okay, thank you, Adam. I'm Randy Henning at American University, and thank you, Peter, for these candid comments. Early next year, we expect to have a decision, or at least an indication, from the European Court of Justice on OMT. So my question for you is, to what extent does the timing and the design of a QE program hinge on the views of the ECJ?
Okay, Morris?
Peter, thanks for that very useful talk. A couple times in the talk, you mentioned the conditions of euro area banks. You had the big assessment on October 26th. As you mentioned, the market reaction has been somewhat disappointing. My question is, how much is that due to the design of the test? In particular, in contrast to the US and what's going to happen in the UK, you did no leverage test in that exercise, and it's well known that if you use leverage ratios instead of risk-adjusted assets, you would have gotten many more failures, and in particular, large French and German banks would have looked much worse. And there's many studies on this. So my question is, why did you do it that way? Why did you decide not to have a leverage test? Is that a political decision, or is that an economics that you don't think it does as good a job? Evidence to the contrary, or what?
Okay, Tara, our last question for this round.
Tara Rice, Federal Reserve Board. So you talked about the ability or the intention of some of these non-conventional monetary measures to reach the most impaired sections of the market. So in particular, we're awaiting the results of the second TLTRO in the next few days. And could you talk about your expectations for that and its ability to reach the most impaired markets? My concern is that, given the contracting loan growth in the stress countries, that the TLTROs won't reach those markets and instead further increase the financial fragmentation in the euro area. Thank you.
Okay. On that, the bidders are especially peripheral or stressed banks from stressed countries, because so that would help them. Not necessarily to make loans. That I agree. It's because the way we calculated the benchmark to beat would make that some of the banks can just substitute bonds for term funding from the central bank at cheaper conditions. that we have seen. But that has an implication in any case for the banks. I mean, that improves the condition of the banks and leads to portfolio rebalancing. You remember that, what I said before? So we have that, and it will be tomorrow, so we have our preliminary figures already now. I will not comment now on this, but it is clear that so it doesn't increase fragmentation. It's the opposite, I think. I don't understand why, because the banks coming are more the banks from stressed countries than from the others. Now you could say they don't have they have an access, but they don't have the capacity to go. But even if it's substitution on the liability side, it's already, we always said it, we prefer them to lend, but even if it's substitution on the liability side, it will help the situation. on the Maurice question, it's, well, I was part of the steering committee, but when we came with the whole exercise, it was, we put the biggest focus was on the AQR, the asset quality review, because we thought it was basically looking at in the books, and all that. Banks, 40 basis sorry, 130 banks. 40 basis points, right? That's what it turned out to be. Well, no, yes, but don't forget that banks did a lot. Yeah, yes, but I mean the end result you may look modest. But because the banks did a lot, maybe they deleverage, as I said before, in accelerated also for the leverage ratio. They did before very much. Now, whatever. The question now is because, as you've seen, the price to books, I mean, I see the very simplistic indicators, is not shooting up. I think it's basically the profitability of the banks. It's the second is the fact that, I'll give you an example which worries more than the leverage ratio, is the fact that the banks have, in principle, sufficient capital for the non-performing loans, but the non-performing loans are still on the books. And so as rightly, I mean, Nicolas and others have said, I mean, is that it would be better to try to work out these non-performing loans than to keep them in book and fund them with relatively cheap money. And so that process, I think, is what we want to induce. So there are, in some countries, legislative changes in some countries, really, to facilitate work out of non-performing loans. But again, I think that for me, this I would flag very high. The second is the definition of capital, which we are working. And so, but we, at the same time, we have to watch the cyclical impact of that and see from the monetary point of view what the micro reactions of the banks to what you say. I mean, it's not, there are still a lot of things to do, that it doesn't end up in a macro equilibrium which we don't want. And so monetary policy has to react. So it's quite a complicated thing. I think we have progressed a lot, contrary to what to say, what you suggest. No, really.
And then, do you want to say anything quickly on the ECJ or not?
And then, yes, Randy, on the, I mean, I would look what the way we work on monetary policy. We try not to be fiscally dominated, as we say. We are not dominated by judges also. So we have made our own analysis. We understand issues, as we discussed a little bit, on the mutualization issues, and monetary policy is mutualization. But of course, we also see the difficulties related to the treaty. So there are ways to deal with that, and we see the first conclusions of the Avocat Général, and we'll see with what they write. But that doesn't come in our discussion. I mean, we act as central bankers, and
I think, Peter, one of the things that's been very striking throughout your remarks and your response to questions, and I apologize, we're going to have to cut off the questions there because of Peter's schedule. He's already been very generous, is that, as you said, and as I would hope most central bankers would, you say, I signed up to the job, I have a duty to this mandate, I'm going to do it as best I can.
Yes,
and
using
take the tools that you have. And I think you were very articulate on that point. Before I release Peter and all of you, I just want to emphasize that as terrific as the speech was, this is one part of our year-closing push to save the euro area. We, as I mentioned, have released today Rebuilding Europe's Common Future, combining growth and reform in the euro area. Next week, on the 18th, we will be having a major half-day event here, restoring sustainable growth and job creation in Europe. We're working together with the outgoing, in both senses, Italian EU presidency. Fabrizio Saccomanni will be giving the luncheon speech, but in addition, we will have presentations by Jay Chopra, Jacob Kierkegaard, Nicolas Ferron, Angel Ubide, and Paolo Moro, with our action plan, as well as comments from others from Europe and from the international institutions. So I hope you'll either join us or watch online that as we continue to move forward. And then finally, we work right up to Christmas like you do. On Friday, December 19th, Pierre Moscovici, the new European Commissioner for Economic and Financial Affairs and Taxation, will be here to give his maiden speech in the U.S. in his new role. We'll be having an extremely good discussion then, also leaping off of what Peter has said, our proposals, Fabrizio. So end your year on a European note with the Peterson Institute, and ideally it'll be a fresh new year for the euro area and for all of us. Thank you so much, Peter, for your remarks today.